Welcome, everyone. It is Angelo Robles. Welcome to At Family Office. To my members, SFO Continuity, welcome. And we're making this one a little bit more broadly open and alive. So we have people from, well, technically all over the world. And that's because I have such a special guest. And we have so much to get to, maybe an hour and a half, 2 hours. And I promise it to be impactful. When you lead with a session, gold to 15,000. Now, that's on me. I'm not telling you a timeline, so who knows, but gold to 15,000, the sovereign debt endgame, and why central banks are hoarding bullion before, well, what I'm calling the reset. So I think this is going to lead down a very interesting discussion with our special guest. And laying out a little bit of context to it, most incredible investors and family offices, I think they're optimized for order. But history doesn't reward over a long enough time frame that order. It does reward what I call preparation under chaos. And really, the top 1% family offices, to me, it's defined by their capability under pressure. Everything that we know is changing. The discussion may get a little bit into liquidity. It will definitely get into sovereign risk. And think about that definition. The probability that government, through policy, which you have no control over, even Mr. and Mrs. Billionaire, incompetence, governments, sure, or malice, confiscation, devalues, restricts, or destroys your wealth, maybe more applicably, your purchasing power. Now, there are some things you could do to hedge it, which we're going to talk about today. I ask for families to ensure in your thinking that your capital, is it going to survive the next year, 10 years, especially purchasing power? And families, some of them that go back generation after generation, they really do think in 100-year cycles. And that leads down the road of our special guest, a return visit, Johnny Haycock, partner von GREYERZ in Switzerland. Johnny, welcome back.
Thank you very much for having me, Angela. It's a pleasure to be on.
Johnny's one of my favorite guests, one of the favorite guests of the audience, one of the best macro and speakers about commodities like gold and silver that I know, and will be a superstar speaker at my forum in Palm Beach the week of March 16th. Really one of our specials. Meeting Johnny in person, I think, would be very valuable. But I have a lot of questions to get to, and let's begin. Western debt to GDP, the ratios are exceeding post-World War II peaks. Without the demographic and industrial base that has enabled the past from effectively deleveraging. What is the realistic end game of these scenarios? And I think people who are intelligent in family offices need to break them out by probability, because there are some probabilities that are very, very ugly in that scenario.
Yeah, look, debt is the biggest issue in the world today. I'm sure we will move on to geopolitical issues that are very prescient at the moment. But you're right, Angelo, that the world is drowning in debt. And it's not just a US problem, it's a global problem. And if you look at global debt, it's just, any chart will show you it's bottom left to top right, and it's just getting bigger and bigger and bigger. And the reality is that you don't solve a debt crisis, which is what we're in at the moment, with more debt. But sadly, that is what is happening around the world. And I think that it's probably best to just look at some numbers. And maybe I can step back a little bit and talk about the gold bull market that frankly started back in 2001, 2002. Gold got down to, $275 an ounce back then. And clearly we've come a long way since then. And I want to come back to putting the gold bull market that's been evident for the last 25 years into context of where we are now and where we go forward, because that's what's important about looking forward, not backwards. But the context is important. But I can give you an opinion. Lots of other precious metals experts in the market will give you an opinion on where gold is going. But the reality is that this gold bull market and where we go from here is based on maths, not opinion. And what do I mean by that? What I mean by that is that, taking the US as the best example, the US today has $38 trillion of public debt. Okay, it's never been higher, obviously. But when you add on off-balance sheet liabilities as well, so on and off-balance sheet liabilities, the US today has $151 trillion of debt. Now, this is it's almost too big a number to get your head around, but the reality is this is just not going to get paid back. And the gold price is kind of telling you that, right? That we're going into a new regime. You throw in the budget deficit of over $2 trillion per annum and growing, that, you know, we can wake up one morning and suddenly find that the US has increased its defense budget from $1 trillion per annum to $1.5 trillion, just like that. So you've got this exponential rise in debt. Now, history, you talk about history, Angela. History shows that there are only two outcomes when debt-soaked nations get to these levels of debt. One, there's an honest default. Two, there's a dishonest default, meaning that that country inflates away the NPV of their obligations in order to, you know, just inflate away the debt. They just inflate it away by printing more money, printing to the moon. Now, very, very few countries choose option one, right? You know, they choose option two, right? And that is what we are seeing. You know, QE effectively has already been restarted again in America. And you tell me, you know, we've got this debt to GDP levels at a time where the US isn't even in recession at the moment. You know, what happens if the US goes into recession? What do you think is going to happen to the debt then? It's only going to get bigger and bigger and bigger. The debt to GDP gets wider and wider. And this is the point that I really want to get across in this conversation, Angelo, that it's not about the price of gold going up. The price of gold is not going up. What's happening, it is the value of money is going down. Now, I know you understand that, but the average man on the street simply doesn't understand that. And governments around the world, it's not just the US, whether it's in the UK or it's in the Eurozone or wherever, governments do understand that. But it just happens very, 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 very slowly. And so, you know, I'll pause in a second, but this is all about the end of a monetary era. You know, you go back hundreds and hundreds of years, all monetary systems end. You know, no currency has survived in its original form in the West in the last 500 years, right? It evolves. And so what we think at von Greyerz, and this view isn't controversial, is that we're just at the end of another monetary system, a fiat monetary system. There is going to be a reset. And unfortunately, you know, the dollar, which is still the world's reserve currency, I'm not suggesting it's going away, but what I am saying is, look, if you go back to 1971, when Nixon closed the gold window, the dollar has collapsed by 99% versus gold since 1971. So what does that mean? That means that there's 1% to go, but that 1% can be another 100%. But we're just at that point, and I would suggest that, and I know we'll come back to sort of the context of where we are in the precious metals bull market today versus back in 2001 at the lows and where we're going. But the simple point is that gold price is just reflecting the decline of fiat currency. And then, of course, I'm sure we'll get into later what the Chinese are doing, and the power shift from west to east. But just coming back to your question just on debt, all history shows is when debt-soaked nations become so over their skis in debt, they print their way out to save the bond market at the expense of the currency. And that is all that gold and silver are telling you today, and it's about reflecting their purchasing power versus a declining and debasing dollar. Sorry, that's a long answer.
No, I appreciate that. My audience likes context, and we are not one to rush things. You leave so much there for me to jump into, chew on, and want to learn about. I agree with you in terms of history. We've had now, an over 80-year run with the dollar post-Bretton Woods. You mentioned 71, where Nixon took us off the gold standard. Yet the U.S. is still the world reserve currency. That doesn't appear to be ending anytime soon. The U.S. has a wickedly powerful military, a president that for sure, like him or not, is absolutely willing to take action. And it's hard to imagine that they won't use any means necessary to maintain that, at least in the current administration. But historically, the Democrats have done things to maintain that status as well. Now, our perspective might be a little different. I'm an American citizen, you're not. And we'll get to deeper, more geopolitical issues that circle around the issue. Where I will agree with you on, you're correct. If you go back through history, the average sovereign currency really lasts only 27 years. Gold has never, audience, do you understand this? Has never been worthless. We're talking thousands and thousands and thousands of years of civilization. So when you bring in the commodities picture, gold and silver, their utilization from various perspectives, silver is very impactful to the build out in AI and around that. You appear to be making a lot of sense. I do want to ask you a dig-in further question on the bigger picture macro. I hear you on the US debt. I hear you on the global debt, including in China, by the way. They're adding to their debt too. But we'll stick maybe now a little bit to Western countries with a focus on the US. We also have a massive deficit. We are increasing our military budget, or trying to, by a huge amount, adding to our deficit even more. The big, beautiful bill, well, print. More money into the system, which arguably is good for the politician, not good for the country long term. We keep on kicking that bucket over and over. Now, AI might be, and the GDP the last 2 quarters have been very intriguing and positive in the US. And we could get into a deeper discussion of tariffs and all that going on in the world, but I don't want to get too far astray. What I may ask you, Johnny, is what are the reserves of gold within the US, or what we believe is in Fort Knox, and what is not rehypothecated, where technically we may not literally have ownership, although I would argue if it's here on US soil, the US owns it, and a military would have to come and take that away, which we know is not going to happen. Pardon the arrogance of an American from that perspective and what I'm talking about. But I add in our real estate, our stock market. The US is massively in debt, and it's gravely concerning. But unlike your country, the UK, or your home country, and other Western countries, we're the world reserve currency, and we have well over $100 trillion of assets here. So you're correct, and I'm relatively on the same page, but I think let's bring in the full picture, Because if it's relatively bad in the US, it's worse in other Western countries that are not the reserve currency.
Yeah, look. I mean, look. I'm a British citizen, and I can tell you that the Britain is in just as bad a state as the US.
Worse.
France is in the same mess as well, right?
Much worse.
Japan is drowning in debt as well. I mean, you don't have to be too imaginative to see that this is not just a US problem; it's a global problem. And as you rightly say, the dollar is still the reserve currency, and I'm not suggesting that is going to change. The dollar ain't going anywhere. All that's happening is that you are, though, seeing this shift, right? Just follow what the central banks are doing, right? They are reducing their treasuries, they're reducing their dollar holdings, and they're buying gold. Okay, and that isn't changing anytime soon. Okay, so again, history is such a great guide. One needs to think about what happened in the last great bull market for gold. Well, so the last great bull market for gold was in the 1970s. Yeah. So these bull markets don't come along very often, right? Certainly in my lifetime and your lifetime, Angela, we may not see another one again. So as Rick Rule famously said, these markets don't come along very often. Don't waste it. Yeah, don't waste it. So let's look what happened in the 70s, if the 70s is a guide. Yeah. So in the 70s, gold went up 28 times, right? And the dollar lost 75%
Wow.
of its absolute purchasing power in the 1970s, right? So if you go back to the start of this bull market in gold, right? So gold troughed in sort of 2001 at around $250, $270 an ounce, right? So here we are today at, what are we, 4,500, 4,700, whatever, in that ballpark, 4,700 today. So that would suggest that if the 70s was a guide, then this bull market in gold has probably got another 3 to 4x to run. Yeah, which gets you to around $15,000 an ounce. Okay. Let me give you one other sort of example. I mean, forecasting, of course, is a mug's game, right? But people want to know, where are we in the context? Yeah. So take Pierre Lassonde, right? So Pierre Lassonde says, and he's infamous for saying that he thinks that gold, he's got a target of $17,200 an ounce. Okay, he's had that for some time. He knows a lot about gold. And I was lucky enough to have dinner with him in Zurich just before Christmas, and I asked him about the science behind that number. And he said, Johnny, it's quite straightforward. You just assume that 1% of private money comes out of treasuries and into gold, and that gets you to 17,000. Okay. Wow. I mean, look, JP Morgan, have even written about this. Yeah, just sort of, you just look at this. There's so much money sitting in, U.S. equities, of course, and U.S. treasuries. You only have to have the smallest shift. I'm talking 1% to have a massive impact on the gold market. And the gold market is liquid. I know we're going to get onto silver later, which is far more illiquid. Yeah, but even in a very liquid market like gold, that's what's going to happen. So I think that again, I don't want to focus too much on where the gold price will end up. What's more important is the understanding of what has to happen to fiat currencies that have to be printed in order to save the bond market. And if we just move on, just a brief comment on the bond market, you'll have seen, what's happening at the long end of a number of these debt markets. Just Japan is the best example. The 40-year bond in Japan today is now trading at 4%. The Japanese own more US treasuries than almost any other country, okay? You have who knows what it will be? What will the catalyst be to break the bond market? Yeah. But there's going to come a time where eventually borrowers say, I'm sorry, I'm not being compensated enough for your mountains of debt, right? For the issues, the risk that I'm taking on by investing in your country. So Japan could be the canary in the coal mine. I don't know. It's impossible to predict, but there will be something that breaks it. And could it be that Japanese investors say, actually, we're going to sell all our treasuries, we're going to bring the money back home because we can now get 4% on a JGB. This is a totally different era to what we've been used to in deflationary times, zero interest rate times when interest rates were very, very low. Yeah. But what's interesting is that the long end of the bond market is smelling a rat here. Saying, hang on a second, we've got inflation in the system and we need to be compensated more to own that debt. So I don't know what the straw will be to break the camel's back. Nobody does. But, the long end of the bond markets are fascinating today. And it might just be that there's a failed treasury auction or a Japanese crisis that really has an impact on, equities. The US stock market, we know how concentrated it is, but maybe it's going to be, a real wobble in the debt market that causes the US stock market that's trading at an all-time high Shiller PE to start to contract. That might be another catalyst, Angelo, for money to shift out of other asset classes and into gold.
Oh, so much there again, Johnny. We leading into questions on central banks, and you really jumped, which is great, to the 15,000 within a relatively reasonable time frame. Right before I get to that, what I will add, and my audience has heard me mention before, Trump's, or I almost said organization, Trump's cabinet, and Bessent certainly is very smart. The Genius Act, what it's doing from a stable coin perspective, buying treasuries, being domiciled in the US, Tether likely needing to move over here in a couple of years, might have been a brilliant play from the administration. If we want to say to keep the Ponzi scheme going of the US dollar backed by nothing, and a strategy globally to make it last for a much longer amount of time without quote unquote military or other intervention, it may just be brilliant. Time will tell. But back a little bit to the core point at hand. So central banks are intriguing to me, Johnny. They're buying gold in record numbers, but simultaneously expanding their fiat systems that they supposedly trust. Are they hedging their own policies or preparing effectively for a reset?
Obviously, I don't know what they're thinking, but I think, look, the most important date, as far as I'm concerned, after 1971, was in 2022 when Russia invaded Ukraine, and the US froze the Russian dollar reserve assets. That was a pivotal point, because if you're a central bank anywhere in the world and you've just seen that the biggest power in the world, the US, has just frozen your dollar reserve assets, what are you thinking? You're going to think, goodness me, well, why couldn't that happen to me? Now, to be clear, the Chinese obviously have been net buying gold and net selling treasuries long before 2022. Yeah. But if you look at any chart, and I can happily share, these with you. It's all public information. If you just look at any chart of central bank buying of gold, it accelerated materially after 2022. That was the starting gun.
Agreed.
For central banks to be reducing the US Treasury holdings and buying physical gold, right? That cannot be confiscated, cannot be stolen or frozen, right? They've got it in their own vaults. And you know, there is absolutely no evidence that that is going to change. And I think that this is all part of the reset. You know, they can see the debt that the US has. They can see that, you know, bonds, government bonds are proving again, right, to be a terrible investment. I mean, you've got to remember, right, bond bull markets tend to last 40 years. And the last bull market in bonds ended in, what, 2020. So we're 5 years in to a bear market in bonds. And of course, you know, the US is lowering interest rates, and we can get into the independence of the Fed and et cetera, and they're doing whatever they can at the short end. But just watch the long end, right? It's the long end that really matters, yeah? And it was the long end. If they lose control of the long end, then that'll bring the short end up anyway. And then that gets into, well, what does the Fed or the US government do about that? Well, that's when you get, you know, financial repression, because they know that given $38 trillion of debt, you know, they have to keep yields down because they can't service it. Yeah. Right. So that's when the printers will really start worrying, right, in order to buy government debt to keep yields down, yeah? But that'll be at the expense of the currency. And that comes back to the original point that this is what gold and silver are reflecting and have been, right? They're looking forward. And interestingly, look at other commodities now. It's not just gold and silver, right? Copper, right? Tin, tungsten, you know, all these other commodities are all showing similar dynamics. You know, gold led, silver following hard, as it always does, right? And now other commodities are coming through. And the question we have to ask ourselves is, well, what is the signal? Yeah, the signal is inflation. Inflation is embedded in the system. So back to your point about your question about central banks, you know, I think they understand this, and they're trying to protect themselves very, very wisely. And there's no evidence that that's going to change anytime soon, unless you were to tell me that the debt situation in the US is going to reverse dramatically. And I don't have a crystal ball on that.
Well, there might be an intriguing perspective, ignoring even AI, as I get into that right now. You actually hinted at it a little bit earlier, but to give the audience a little context, central banks hold, I believe, about 36,000 tons of gold against, like you also noted, 100 trillion effectively in sovereign debt. Do the math, do the challenges in globally, but certainly in the West. So you hinted at the US also hoarding gold, using its might and arguably extracting in various ways from others, some would state. If the US has more gold and acquires more and more gold, and thinking back to Roosevelt in, was it 33, with basically confiscating at a lower price people's gold, a little bit of Nixon in 71, I'm thinking of gold revaluation. Now, this could be a little bit of a hammer on a lot of the audience's head. They may have a little hard time initially wrapping their arms around it, but governments do have the ultimate power. We know that. If the US is able to hoard gold, and we're not even exactly sure what we do have, and we're able to kind of reset the market, you could say manipulation. Could it easily go from 4,000 plus an ounce now to the betterment of the US 3, 4, 5x that, and the impact that could have on effectively even paying down a portion? Now, 38 trillion plus is a huge number, but potentially a strategy to pay down a portion of our debt. Am I crazy?
Okay, I'm going to answer that in a second.
Let
me just there's a lot there. Let me
You're
answer
not crazy.
I've just got some numbers in front of me, actually, on the central bank shift from dollars to gold, right? So 10 years ago, central banks held 88% of their reserves in US dollars. Okay, that number is now 58%. So 88% has gone to 58%. Okay. Meanwhile, gold has gone from 10% to 20%. Okay, so there's absolutely no reason why those trends won't continue as the architecture of the old monetary system evolves into the new system. And of course, the same applies to the sterling, and it applies to the yen, and it applies to the euro, right? But I just want to give that context about where reserves are, yeah? Look, on revaluation of gold, the von Greyerz view is that we won't see a revaluation of gold. There are plenty of commentators in the market that think that we will. Okay, but for what it's worth, von Greyerz doesn't think that that is going to happen. Why do you think, Angelo, why do you think that we keep getting told that the one thing you need to realize about President Trump is that when he says something, he means it? Yeah, this is the lesson. You know, when I watch the news and I'm listening to, you know, US government officials talking about Venezuela or talking about Greenland or whatever it may be, yeah, they keep saying the president is a man of his word, right? And when he says something, he means it. Why is it then that when he got elected for his second term, he said that he and Elon Musk were going to go down to Fort Knox and they were going to audit the gold? And it hasn't happened. Why do you think it hasn't happened? I wonder, it's because it might not be there. Okay, I don't know.
Literally, physically, or in contract?
I don't know, right? I don't know, but it's kind of interesting, isn't it, that he hasn't gone to Fort Knox?
Yes.
Okay, so we can just surmise, well, why is that? Maybe there aren't the 8,000 tons that the World Gold Council will tell you that the US has got. I just don't know, right? Okay. What I think, though, is what is the impact on a revaluation of gold on, you know, other countries, the US adversaries, China, Russia? Well, China and Russia own an awful lot of gold. Right? So if the US revalues, it's going to help China and Russia. Is that something that US wants to do?
Let's go with no.
I have seen research, which I can happily share with you, Angelo, from a very, very highly regarded commentator in the gold industry, Alistair McLeod. And he has done some analysis showing that, it's all from public information, that the Chinese probably own an awful lot more gold than official statistics will have you believe. Possibly as much as 35% of above ground gold stocks, maybe even 40. Maybe that is the reason why President Trump and Elon Musk never went down to Fort Knox. But that's just sort of, you know, speculation. There are others out there that think that it will happen. Okay, so let's take that view and say, well, it does. The number that gets banded around is $20,000, right? If the gold, the 8,000 tons or whatever, is revalued at $20,000 an ounce from the $42.22 that it's in the books at the moment, right? Then that's about $5.2 trillion credit to the TGA. Now, it could be that it happens. And then maybe, that will be, Trump's way of standing up and saying, look, I told you what I'm going to do. I'm going to get the debt down. And this is how I've done it, because I've monetized the asset side of the balance sheet. I mean, it could happen. But goodness me, can you imagine the dislocations in the market if that were to happen? Imagine, if you own an ETF and you seriously hope that ETF is backed by gold. Can you imagine the banks? I mean, look what's happening in the silver market at the moment, right? I mean, there's, who knows what sort of losses may or may not be incurred by banks that have been short silver during this recent surge. I mean, that would cause enormous stress in the financial markets.
Indeed. Johnny, what I'm going to do, I have a million more questions, but someone in the audience does bring up a fair point. I promised I would be better at it this year. And last week I miserably failed when I had two guests on for multiple hours each. And that is doing more audience interaction and questions. And again, the audience is going to be heavy investors and family offices, that there are times we do need to, without waiting to the end, give them some insight and direct impactful on the investing perspective. Two of the questions are always a little bit challenging and unfair, but hey, it's great clickbait. By the end of this year, do you have an approximate estimate for what you think gold and silver, as a question came in, could be?
Oh, I'll try to answer that. But again, I come back to the point that it is really, I really want to stress this to your audience, Angelo. It's not about the price of gold and silver going up. It's about the price. It's about the value of your dollars going down. If there's one takeaway from this discussion, it is that. Please don't focus on the price of gold going up. It's not. It's the value of your dollars going down. Okay? But if we're going to start talking about where gold and silver can be, in the next year or so, right? I mean, who would have thought that, earlier in last year, what was it, in sort of April, May last year, silver was $35 an ounce. and here we are at 95. Okay, so when these things really move very, very quickly, particularly in silver. Forecasting is a mug's game, and we stopped giving target prices some time ago for both gold and silver. All I will say, though, is that in February of last year, when the gold-silver ratio hit 100, breached 100, that was when we said to our clients, look, you really ought to be owning more silver here, because silver was unbelievably cheap on any historical metric versus gold. Just, look at the gold-silver ratio chart going back 100 years, and you could see that at 100, yeah, that was unbelievably cheap. We haven't always recommended silver, okay? When silver goes into a bear market, it can be extremely painful, okay? And of course, that's what happened after 2011, which was the last peak, and of course 1980, okay? So, but over the last, I would say, 5 years or so, 5 or 6 years, we've recommended clients their precious metal allocations be 80% gold and 20% silver. In February of last year, 2025, that's when we said that there should be a shift from 80-20 to 70-30 in gold's favor. Yeah, because the volatility in silver is that much greater. Okay. That said, we also said to clients, look, if you can stomach the volatility, then having 50-50 gold silver makes total sense. And even as we sit here today with the silver price at $95, you need to remember that if you inflation adjust silver to its 1980 peak, it needs to trade at $200 an ounce. So if you did the same exercise for gold, gold has already eclipsed its 1980 inflation adjusted peak when it went through 3,900. Okay, and now we're sailing on beyond that, yeah, at 447 today. Silver hasn't even got back to its inflation adjusted peak of 200. So there is a very valid argument to say that the bull market in silver will only start when it's reclaimed its inflation adjusted peak back in 1980 at $200 an ounce. And think about how the market has changed, or the world has changed so dramatically today versus the last peak of $50 in 2011, and then the previous peak in 1980, $50. It's the industrial usage for silver. So in 1980, only 20% of silver produced went into industrial usage. Today, that's 60%. Think about that. 60% of all all silver produced today goes towards industrial use for solar, for batteries, for photovoltaic tires.
All things that are wickedly going up and needed more of.
Yeah.
Yeah.
And this is
AI. Build out infrastructure.
Yeah. If the AI revolution, which is clearly here to stay, and that's happening, you've got to power this. It's right. It's got to happen. What's going to fuel it? The EV transition. Solar, right? Climate change. Silver is all part of it, which is why, if you're Tesla or you're Samsung and you need silver, right? You're not going to say, well, it's $95 an ounce. I can't afford to buy it now. Of course not. You buy whatever you're going to pay whatever it takes. And this is the big difference today in the silver market versus the 80s, right? Which was driven by the Hunt brothers, of course, when they tried to corner the market. But they tried to corner the market, albeit in the paper market. Today, it's all about physical shortages. It's the physical shortages. And so to the audience question, where can silver go? Why can't it be at least 200? Because I think we are now seeing that the pullbacks are becoming shallower. They're becoming more short-lived. And I think we're now in the acceleration phase. We're clearly in the acceleration phase. And I think that, the retail investor, a lot of retail investors will say, okay, I want to own some precious metals. Gold and silver, I don't own any. But they might not be able to afford gold, right? At $4,700 an ounce, right? But they might be able to afford silver at $90 an ounce, or $95 an ounce. So you could see some transition of purchasing away from gold into silver in a very, very illiquid market with big industrial buyers hoovering up all physical. And that's why you could see a re-rating of multiples for silver. Is that by the end of this year? Possibly. You know, I mean, who would have thought that silver would go from 35 to 95 in the space of what, 10 months or 9 months? So it's very, very possible. And as for gold, I think that, you know, on a longer term, on a multi-year basis, what's going to be the driver for gold to go to 15,000? I think the driver for that will be a sudden wake-up call, a sudden realization that wealth managers, pension funds, institutions have to protect their portfolios against currency debasement. They just have to do it. And I think that could be the driver to get to 15,000. And then, just to really round off the question, so if the gold-silver ratio, you know, let's take Pierre Lasson's target of $17,000 on gold. And he's a far cleverer man than I, knows the gold industry inside out. Let's just say he's right, yeah? So let's say, and by the way, you know, his view is that happens in the next few years. So if that's the case, and then you say, well, a gold-silver ratio of 30, yeah, which is where it was, it got where the gold-silver ratio got to in 2011, intraday it troughed at 30, yeah? Well, apply that 30 gold-silver ratio to 17,000 gold, you get a silver price of 566. Does that help?
Johnny, there's some excellent questions coming in from the audience. I'm going to do 3, maybe a little bit rapid fire because I don't know, about 30 more questions to get to. So Rangers and Robert, thank you for your kind comment. And Xavier, you always ask good questions. So here they go. This is Xavier.
Gentlemen, I hope they're not hard.
No, this one is right up your alley. Gentlemen, he states, for Gulf sovereign wealth diversifying away from dollar reserves, how does compliance architecture for Swiss physical gold storage differ from Singapore, given U.S. secondary sanctions risk? It's a deep one.
Look, I can only talk about what we do at von Greyerz. Okay, so look, we have clients in over 90 countries around the world. Obviously onboarding and anti-money laundering, KYC is absolutely paramount. And obviously, just like a bank, understanding ID verification and proof of funds and source of funds is absolutely everything. Reputation is absolutely everything. And so in Switzerland, where obviously we are incorporated in Switzerland, regulated in Switzerland, et cetera, you know, we have very, very stringent rules. And we take in client money from, as I said, over 90 countries around the world. And so, you know, if we can't be sure of the legitimacy of those funds or the legality of those funds, then we simply won't take it on. And, you know, look, obviously we are a private business. I would suggest that, you know, if you're going to store gold in a bank, which by the way we certainly wouldn't do, and we can come on to that in a moment, then banks are going to have the same the same regulations, right, and the same tests to overcome. So all I can do is speak for us at von Greyerz. Touch wood, you know, the moment you lose your reputation, the business is over. And we thankfully have never taken on a bad apple, but we do our due diligence before opening any account.
A difficult question, which would be one of mine as a follow-up to that. It's a little bit politically charged. So Switzerland, the banking system, we saw some buckling in 2008 to the US. They appear to have a very cozy relationship with the US. And although I'm not going to ask you whether the US extracting Maduro from Venezuela was a good idea, I will ask that Thursday to our guest, Jason Ma. I think it's somewhat unfair to Johnny. But I heard, and maybe it was rumor, I'm not confirming it, but the Swiss banking system, oh, well, we're going to freeze their gold and the assets, meaning Maduro, and give it back to the people. This sounds like the US using undue influence. Where's due process? Now, I may think the extraction of Maduro was a good idea. I do believe in the Monroe Doctrine. And maybe I'm talking out of both sides of my mouth, but could there be some level of due process before the money's frozen by a country that's not even the US? They're making some assumptions here, and this is showing that governments, especially the US with military and other might, is kind of all powerful. There is no place to hide. And again, I'm throwing at you a question that is just loaded. I know you want to be a little careful, but I'll answer a part of it for you. And tremendous value of Von GREYERZ in what they do in gold and silver and arguably other commodities is not only is it in Switzerland, it's an incredibly unique location, which Johnny may get into. It is not, capital letters, NOT, not a part of the banking system. Johnny, if you want to elaborate.
Look, firstly on Switzerland, look, for 25 years, we have been analyzing risk, and we analyze risk every single day. If you think about, our business is all about protection of wealth. That is what we are passionate about, protection of wealth in the face of debasing fiat currencies. That's it, okay? It's very simple business. When we look at the world today, nowhere is perfect. But in our view, Switzerland and Singapore are the two lowest risk jurisdictions in the world to be holding physical gold and silver. Okay.
If I may just ask,
yeah,
why not the U.S. being a third option?
if the U.S. suffers in the way that many people think that it might do because of the drowning in debt, then if you're worried about confiscation of gold, I would suggest that it's best not to have your gold in the US if you are a US citizen. When you look at Switzerland, right, the gold industry is integral to the economy. It's about rule of law. It's about democracy. They have a referendum on pretty much anything before anything can change. Switzerland refines 60 to 70% of the world's gold bars. Yeah. So gold is totally integral to the economy. And it would be staggering if Switzerland were to shoot itself in the foot by doing anything to change that. There are plenty of questions that we get every day from investors who are worried that, and obviously Switzerland is not part of the EU, okay? And we get questions from clients, frequently suggesting, could it be possible that the EU pressurizes Switzerland in any way, yeah? Or the rules change in Switzerland. Look, we monitor this, but at the moment, there is no sign of that happening. You may have seen there was a referendum very, very recently in Switzerland questioning whether there should, the ultra-rich in Switzerland should have an inheritance tax, which there isn't at the moment. It was voted down 80-20. So you're absolutely right that, I think it was the UBS case back in 2005-06 in that area where the US forced UBS to reveal certain client data for US citizens that had Swiss bank accounts. That wasn't a great day for Switzerland, right? But if you're a US citizen and you own physical gold in a private vault outside the banking system in Switzerland, you are under no obligation as a private citizen to disclose that to the IRS. What you are obliged to do, of course, is when you come to sell, if a US citizen comes to sell their gold, then of course they are obliged to disclose a capital gain, yeah? because there's capital gains tax on gold, obviously, in the US. But because physical gold is not a financial instrument, as opposed to an ETF or precious metals mining shares, for instance, there is no obligation to disclose that to the IRS when you're buying it. So if I were, and this, the North America is our biggest market. We have more clients from North America than any other market, and for good reason. If you think about the seven principles, or 6 or 7 principles upon which that we, or Egon von Greyerz, founded this business 25 years ago, it was the following: if you're going to own precious metals, you need to own them physically, you need to own them in your own name, you need to have direct access. Nobody should have a legal claim other than yourself over those assets. They need to be in the lowest risk jurisdiction in the world, in our view. That's still Switzerland and Singapore, number 2. And fully insured in Lloyd's of London, in the world's most secure private vaults. So the question I would have to anyone thinking about owning gold is, why would you own your gold in your own country, in a bank, where there's counterparty risk? Yeah. Why take that counterparty risk when you don't have to? That's
very good points, Johnny.
That's the question. This is your insurance, right? This is your diversifying hedge outside of the financial system. You've got, let's say it's 10. Let's say you put 10% of your net assets into gold. Well, your other 90% is exposed to the financial system. With your insurance policy, why take that risk?
All good points. There are 2 audience questions I'm going to get to. I did want to follow up because it relates a little bit to my Venezuela, Maduro, and you actually hinted at it earlier. So a couple of years ago, the U.S. freezing 300 million Russian oligarchs' dollars because the dollar was weaponized. The all-powerful U.S. dollar, the United States using its reach as a world reserve currency to make a decision who's bad, who's good, and doing something as an extreme libertarian on freedom despise, and that's basically taking my freedom, my money, which is my access to resources to defend myself in situations. We could argue they were bad guys. They probably were. But that doesn't mean that I like the concept of that. So why hasn't that killed the dollar dominance yet? And that was a couple of years ago. And really related to how much time does the dollar actually have? It's 70%, maybe 66% of global transactions. That number gets lesser and lesser. No, there's not an immediate replacement next month, next year, probably within a couple of years, but the ratio appears to be going down and down. And that threat of, if the assets are in dollars, that we're just going to shut off that spigot is kind of scary.
Look, it's happening very slowly. The US dollar is losing, 8% or 5% of its purchasing power per annum. And people, it's not something that the man on the street just sort of sees. He just feels it. The elastic band of inequality is just getting stretched and stretched and stretched and stretched and stretched. And at some point, can't predict when it breaks. And it goes back to what we were saying about the bond market. If suddenly, yields spike higher because central banks around the world lose faith in US treasuries because, for whatever reason, the debt or geopolitical concerns, well, because of the mountain of debt, money just has to be printed in order to buy those bonds to keep yields down. They don't have a choice. That's what's always happened. That's the dishonest default, yeah? Just inflating away the NPV of the obligations. And then you have financial repression and QE, and who knows, you might have capital controls. But But that's what happens. It's slowly, suddenly. This is my point. The dollar has already lost 99% of its value versus gold since 1971, but it still leaves that 1%, which is another 100%. Who's to say that this isn't the year where you see an acceleration of a decline in the dollar? Who knows for what reason, right? Whether it's foreign policy or whatever, a bank goes bust or a failed treasury auction or whatever it may be. But what I think, not just gold and silver, but what commodities are showing you is that there is this paradigm shift from a world that has been dominated by financial assets to hard assets, real assets to protect against inflation. And I think that is what gold and silver are telling you is happening today. And I think, look, we get asked a lot about capital controls and confiscation. I think confiscation of gold is very, very, very unlikely. I think it's very, very unlikely because if you think about it, it's such a small market versus the treasury market versus real estate, equities. If they really wanted, if the US government or frankly any government, wanted to, get in more taxes or whatever, there are far easier markets to go after than gold, right? Far easier. Why not just a wealth tax or whatever it may be?
We know all about that, those of us in California, and what's proposed and likely to happen, and will spread throughout the U.S. and likely the world, but we'll save that discussion. Go to my one with David Lesparens from last week, everyone. That was pretty deep on that.
But my point is, my simple is there are so many other ways to get money out of the population than going after gold. But if I am going to own gold, I'd rather own it where I can touch it and I can feel it and I can get direct access and no one else has a legal claim. And obviously, if you're owning it offshore in a low risk jurisdiction like Switzerland, well, that's the best. It's the best way to own it, in our view.
Excellent. I'm going to get to the two intriguing questions from our audience in a second. We do have, Johnny, you're a popular draw, more people on YouTube than I've had in a while. So a lot of new audience, everyone on Angelo Robles. And I do recommend subscribing in my YouTube to @FamilyOffice. I appreciate you. A little bit of context, had some incredible discussions this year. They're up on my platform. I just mentioned David Lesparens, who was an incredible guest, Jordy Fisher from early in the year, and this past Friday, Philip Markovici, actually, including David, including Philip, including Johnny, 3 guests in a row, all based in Europe. So, my God, I need to have an American guest on, which is coming up on Thursday. If you're going to be live this week, I have on Jason Ma, a fellow thought leader in the family office world. Last time he was on 18 months ago, 3 hours and 7 minutes. It won't be that long, but it'll be 2 hours. And it'll be broadly in geopolitical and a lot of different issues, constantly tying back to investors, families of wealth, and family offices. So I do appreciate many of you. I will be at Uncorrelated Conference in Miami this upcoming Monday, the 26th, leading their family office day. Perhaps I'll meet some of you there. And as noted, my marquee program for my members, the week of March 16th in Palm Beach, Johnny will be one of our featured speakers and likely be with us for 3 or 4 days that week, a chance to interact. So lots going on. We hope you're a part of what I'm doing. 2 questions also from the audience. Rangers notes, and I may not be quite catching the context of this, but Johnny, you'll probably get it. With AG becoming more out of reach for most of the population, do you think fractional AG, like the old, I think it's 1/10 of an ounce Roman denarius or Greek Deutschmaß, will receive more attention or copper?
Yeah. Look, Look, absolutely. Sort of goes back to my point that, if gold is $4,700 an ounce and silver is $90 an ounce, or $95 an ounce, then there will be, people the man on the street that will say, I can't afford gold, but I can buy some silver. And of course, you don't have to buy a whole ounce, right? You can buy half an ounce, right? Or quarter an ounce. So absolutely, you can buy coins. This is another thing that we say to clients all over the world. If you're a family office and you're a client of ours, and you've got millions of dollars stored in our vaults in the mountains in Switzerland, that doesn't mean that you shouldn't have a small amount of gold in coins, portable, near to home. Absolutely, that makes total sense. But the bulk should be overseas in a secure private vault. So the answer to the question is absolutely, yeah. Look, and I think tokenization of assets has been around a long time already, and I think we're likely to see more of that. I mean, now's probably not the time to go into the difference of tokenized gold versus owning physical gold outright. But that will be another way as the gold market evolves, that people that only want to own smaller amounts of gold will be able to via a gold token, as long as it's physically backed by gold. I can see that happening, but that's a very different asset class to what we're involved in.
And I think you answered some of the next question, but he does ask it in a unique way. I'll throw it at you. Michael states, if silver gold are mined at 7-to-1, gold isn't consumed, but silver is there an argument silver could be more valuable than gold at some point going forward?
It really is possible. Look, I'm not going to go against 5,000 years of history and say that is going to happen. However, there is a real chance that the gold-silver ratio overshoots the 30 level that it got to in 2011 and carries on going down, right? For the reasons that we talked about earlier, because of the industrial usage today, it's being consumed. And that is a game changer for the silver industry. So I would say that there is a credible case to be made that the longer term gold silver ratio actually goes to 15, 10, maybe even single digits. It really could. Could it be 1-for-1? Don't know. I don't know. But I think it's a really interesting question, and I think it's a very important question. And it's partly because of what the question is implying that we think that silver today at $95, remember what I said, just to get back to inflation-adjusted peak, it has to be 200, yeah, of the 1980 inflation-adjusted peak. So it's a long way to go. It's a double from here just to get back to that level. We see silver as a generational opportunity at these prices for both wealth protection and wealth enhancement. And it's quite rare. It's very rare, but it's a great question. I don't have the answer.
I agree.
But I think you could see a single digit gold silver ratio, because people, I think, will start to think like that.
Johnny, I'm going to go back a little bit to bigger picture geopolitical. And again, these will be deeper in my discussion with Jason Ma. A little bit unfair for me to ask Johnny, but I think he'll tie it into the core topic that we want to state. So Trump's Venezuela, Iran, Greenland moves seem to be designed, I could argue, to accelerate dollar de-dollarization. Maybe strategic genius. Could be, some would state incompetence, or does it matter since the debt forces the outcome anyway? Do you have a perspective?
It'd be very interesting to be in Davos this week, I can tell you.
It always comes back to Switzerland.
It would be very interesting to hear what some of the central bankers, say to Donald Trump when he arrives. Look, this is what I think about that. We've all heard of the phrase, "My word is my bond." Yeah, we know that phrase, right? And I think that is very, very, very relevant for what we're seeing today. When a system loses integrity, money flows away from it. And unfortunately, whether we like it or not, the new reality is that institutions, whether it's a NATO alliance or it's the independence of the Fed, right? These institutions, the integrity of those institutions are being questioned. And I think that sort of the printed contractual promises, i.e. paper money, that have been absolutely fine in times of calm for so long, are now increasingly being exchanged for the 79th element, which is gold. Yeah? So I'm not going to give you my view on Maduro. I'm not going to give you my view on Greenland. That's for other people. It's for you to decide what you think about that. But I don't think it's in doubt that integrity and trust in the system is starting to break down. You know, the Danish central bank came out today and said that they're going to sell all their treasuries today. I mean, I cannot believe that anything that we're seeing at the moment, whether it's Venezuela or Greenland or Iran or whatever, and tariffs. I mean, just the unpredictability of the greatest, most powerful nation on earth. That unpredictability is just going up every single day. So you ask about de-dollarization. I cannot see how any of these policies aren't going to increase de-dollarization. And again, this is probably for other guests that are far more qualified to talk about geopolitics than I am. But even if Trump rows back on Greenland, I mean, the genie's out the bottle. That integrity is being questioned. And that's why I think the de-dollarization trend is only going to continue. But that's just my view.
And Johnny, I think a very important question, which relates to allocation and investing with investors and mainly my audience, family offices. And you did also hint at this one earlier. Now, we have discussed in the past, we've looked at Goldman and UBS surveys of family offices where they ask about things like commodities. And the percentage of allocation left us both needing to have another cappuccino. We were shocked. So gold, we don't know for sure, but debatably is at under 1%, likely about half of 1% of financial assets versus maybe quadruple that at 2% historically. And arguably with family offices, it might have been 6 to 8% in the late 70s and 80s. What happens to the price if we just mean revert, which you did hint at? I know I'm being repetitive, but I think it's important. We mean revert to even a lowly 2%.
No, you're spot on, Angelo. The actual stat is that gold today is 0.5% of world financial assets. The multi-decade average is 2%.
Right.
And in 1980, it hit 8%, as you rightly said. And there just simply isn't the supply of gold to satisfy that demand if the percentage moves from 0.5% back to the mean of 2%. That's, as you say, that's a quadrupling of demand that can only be satisfied by very materially higher prices. But look, it wasn't that long ago, right? I'm talking the last decades, when many wealth managers and many institutions and pension funds actually owned gold. It wasn't that long ago. I mean, I remember it was maybe 25, 30 years ago, something like that, when Rothschilds was one of the biggest fund managers in London, and they had 20% of their assets in gold. Mm-hmm. And that's just not the case anymore. And it's not the case anywhere. And I just think that, we're going to get back to a point where everybody, the norm will be to have an allocation to the asset class. It's been around 5,000 years. It got ignored for basically 50 years, right? Because of printing of money, free money, stock market's doing so well, property market's doing well. We have a crisis like 2008 and the world gets rescued by printing and printing and printing money. And people have forgotten what gold is all about. But it's quite interesting, now that, gold is back in the headline. It's back in the headlines a little bit. And people are realizing that, their purchasing power is going down. There's a cost of living crisis, and owning a little bit of gold, can actually protect them a little bit. And I think that the future will be, in the next 5, 10, 15 years, will be that wealth managers will allocate to the asset class a percentage that they don't today. And some do, Angelo, right? Some wealth managers in Switzerland, I know, do that, but they're very much in the minority.
Of course. And we might be at the stage, Johnny, where if I have about 10, which is a fair amount of questions remaining, maybe one or two from the audience, and this applies to me more than anyone, we'll go slightly quasi rapid fire, because I think there's some good questions and value to the audience and the family offices. So the paper gold market is what? I don't know, 100 to 250x annual production. What triggers the run on bullion banks when paper can't convert to the physical?
Well, look, you're starting to see it in the silver market right now. I think that the elephant in the room is the fact that these ETFs, gold and silver, we know that there just isn't the gold out there backing every ETF out there that is saying that it's backed by physical gold. The gold is hypothecated and rehypothecated and rehypothecated again. And I think that at the end of the day, when you own an ETF, what do you actually own? You own a claim.
Yes.
It's a claim on an asset that tracks a price. And you've got a daisy chain of counterparties in there, right? Because let's say there is the gold there. Well, the gold has to be stored somewhere, and the gold is stored in a bank. Yeah. So you've got the ETF provider, you've got the bank, you've got a daisy chain of counterparties. Now, of course, the luxury with ETFs is they're very liquid. You can buy and sell them quickly, and they're cheap. But I'm not going to get into our fee structure at my firm. But the reality is you're taking, I think, an increasing risk by owning a paper asset versus the physical, which obviously, yes, you're going to pay a little bit more for, but I'd far rather pay, and this is what certainly our family office clients say, they're happy to pay, and just high net worth individuals, very happy to pay a few more basis points to sleep well at night, knowing that you can get hold of your gold, that no one else has a legal claim, that you're minimizing counterparty risk. But I think I think the pips are starting to squeak now, and we can see that in the silver market specifically. And going back to what we were talking about before, if goodness me, if gold were to be revalued from say $5,000 to $20,000, as some think, we don't, but some do, right? What dislocation would that mean in the ETF market if everyone wanted to sell and get their money back?
I think we know the answer to that.
Would the ETF providers say, sorry, force majeure, this is an unprecedented event, didn't see it coming, we'll make you good, but at last night's close?
Yes, very, very good points. I kind of asked you this question when you were on, which was about 15 months ago. So those that want to go back through my @family office and go back to, I think it was October, it might have been late September of 2024. I did my first interview with Johnny. At gold, it's a little bit of a conspiracy theme. At gold above 4,000, yet I still generally doesn't seem to, it's barely covered broadly by the media.
Yeah.
I don't know, a feature or a bug. Are there dark forces at play keeping gold kind of under wraps? And who benefits from gold being kept boring and controlling, manipulating its price?
There's plenty of chat about bullion banks suppressing the price of gold and silver for many, many years. There's actually public transcripts from the Bank of International Settlements, or an economist at the Bank of International Settlements, and from the former governor of the Bank of England. And they've actually come out and publicly said that there are times where they have been, you see strange movements in overnight, and when the US is asleep, you see strange movements of many futures being sold in the gold market, and to suppress the price. But let's be honest, what does it mean when the gold price is going up? It tends to reflect two things. One, the devaluing or the debasing of paper money, but two, the mismanagement of an economy. And so if you're a banker, if you're a central banker or president or prime minister, it's not great to see the gold price going up, because it's simply a mirror on what's happening to your currency. So of course you could say, yes, it was in their interest to suppress prices, but it seems to me now that, and certainly again, it's much easier to see in silver that these bullion banks are getting run over because the game has changed, right? When you have big industrial buyers, right? I mean, who wants to be short silver now? I mean, you take massive losses. So I think there is an element of truth to that, but at the end of the day, it's just the paper money going down. That's what the gold price going up is reflecting.
And we kind of have went over this variation, which someone texted me twice, but it's asked in a more creative way. And I think it's important to hammer home with the audience. The gold silver ratio collapsed from 90-1 to 50-1 in months. What does this velocity tell us? And can we hit, interesting question, a 15-1 this cycle?
I think we can. I really think we can. Look, I spent some time last night replying to an American client of ours who owns an awful lot of silver, who was asking me this very question last night. He owns a lot of silver. He's seen the ratio fall to 50. And the question he asked me was, at what point do I reallocate or rebalance my allocation out of silver back into gold? And my answer was, as I said earlier on in this discussion, Angelo, I think the first staging post is 30, right? Because that's where the ratio got to in 2011 intraday. I think it closed at 35 that day, but anyway, 30, 35 in that ballpark. But let's say 30 is the staging post. But I do believe, because today silver is at the intersection of sound money and industry. And that is very different to where we were in 2011. So I do think, I think there's every chance that we overshoot it. and it goes further, 15, 10, maybe even single digits, just as we've already discussed. But you've always got to look at it, what's happening to the gold price at that time? Yeah, I mean, if we get a financial accident, we get a geopolitical event, we get a failed treasury auction, or the Japanese bond market collapses, well, what price is gold going to be? Gold's going to be an awful lot higher. Yeah. So I think that gold will be an awful lot higher, and silver will do even better, right? But the pricing. Just think about that Pierre Lassonde example: 17,000 gold, a gold-silver ratio of 30, and you get to 566 for silver. If the audience question, if the listener is right that you get to a gold-silver ratio of single digit, then clearly you're looking at a massive number for silver, and that's why we think that genuinely this hasn't really started yet.
And maybe a question or two relative to kind of a 40-year cycle reversing, which is why I'm concerned a lot of family offices are being caught a little bit flat-footed. And that basically is mining is 1% of the S&P 500 at the exact moment, Johnny, now a little bit in my bailiwick, when AI needs copper, lithium, rare earths, and it just can't move silver, etc. It can't move fast enough. This is a disconnect, supply and demand. And to me, hard assets, commodities, build out of the infrastructure, energy are obvious plays to be, I'll go with the word, a little more overly concentrated than you likely are as a family office in this year. Yeah. Maybe I'm wrong. I've been wrong before. But mining at 1% of the S&P, the lowest in memory, where does that make sense?
This is the mega trend of the next 10, 20 years in my view. This move from financial assets into hard assets, into real assets. And just look at any chart over the last sort of 50 years. If you look at gold versus the Dow, look at gold versus the S&P, gold versus NASDAQ, look at silver against the same charts, okay, what you can see is the most unbelievable breakouts happening across so many of these asset classes. They've all broken above the trend lines. Yeah, because as you say, look, it's all about technology, right? What is it? Seven companies in the US, the concentration, was it 20% of the S&P? Or, we all know the concentration is just huge, but these things mean revert. I'm not suggesting for a second that Microsoft and Google and Nvidia aren't wonderful companies. Of course they are. But mining, if to power the AI revolution, there's been no investment in mining gold mines or silver mines or any of these mines because it hasn't made economic sense to do so because the prices have been so low for so long. But it takes 10 years to bring on a mine. Now we're suddenly hearing that silver is suddenly a critical mineral, right? China are restricting the export of silver. And you can just see where it's all going. Again, please, this is more a question for better qualified people who can comment on geopolitics than I can, but Venezuela might have been about oil. Greenland might be about natural resources. Right? Question, right? I suspect it's got something to do with it. And so when you look at the scales have been so tipped in one direction, tech, and that's the US, that's where everyone is. But just look at mining as a percentage of the S&P, as you say, it's an all-time low.
Yes.
Just at the point where all these commodities are telling you that inflation is embedded. I think it's an enormous signal. And I honestly don't think fund managers, family offices, wealth managers, institutions, I just don't think they're positioned.
Well, that's 100% the case. We hinted at that. Per studies, there's always individual exceptions that show that effectively, broadly, commodities, let alone gold, are, well, broadly under 2%. Gold, very well, like you said, half of 1% in most, and silver probably just basis points, if any at all. And how does that math make sense from some of the macro geopolitical, and even those like me that are very active in AI and technology? The build out of what's needed is going to be energy. The build out, the commodities are simply the 40-year bull run in financial assets. Yeah, that's with falling interest rates and globalization. The next 25 years, as you hinted, could be a reverse course. And what does that mean reversion look like when, the Buffett indicator is effectively at all-time highs? So that does beg another question to family offices. I asked this question to someone that I believe you're familiar with and maybe a fan from afar. My friend, Mark Faber, boom, doom, and gloom, Swiss economist who's been in Asia now for decades. And I believe they even took my interview with him, which was my second or third one this past summer, down. So maybe it's on some of my other platforms that hopefully we'll get Mark on in a couple of weeks. He's always a colorful guest. He takes out his cigarette and beer. I could take out some scotch in my cigar. Maybe that's actually why they took it down. Okay, maybe a lesson learned on my part. I got to do that one on Rumble only. But what percentage of a family office's portfolio, maybe not the average high net worth, the family office's portfolio from everything we're describing should be in commodities broadly? He, by the way, said 20%. Not that I want that to skew you. So 20% hard assets, commodities, maybe him and I are on the same page in that. Maybe you think lower. Maybe you think that's about right. Maybe you think it should be 50 to 75%. Do you have an opinion?
Look, we think that every family office should have at least 10% in precious metals. Okay, we have clients that have materially more than that. We have private individuals. So private individuals, not necessarily a family office, but private individuals, high net worth individuals, who have well over 50% in precious metals. But 10%, I would say, would be a very good starting point from a very, very low base. And I think you could then debate between 10 and 20. In terms of commodities in general, yeah, look, I'm not an expert on copper. I'm not an expert on lithium. I'm not an expert on tin, et cetera, et cetera. But I think all the signs are there, right? That having exposure to other commodities as well as precious metals is highly sensible.
And I know it's not quite in the bailiwick of what you're describing with physical ownership of gold, but I think you would have an opinion, and that would be, and relative to, again, supply and demand, opportunities opening up, maybe lesser stringent ESG mandates, allowing global mining stocks are what? Mining stocks historically give 2 or 3 legs leverage to gold, but data broke. Do you have an opinion on investing in mining stocks?
Absolutely. I think they can do incredibly well.
Agreed.
And look, I think, as my dear friend, Ronnie Sturfler, who you probably have heard of, and he's a great authority in the gold market. This is the way he describes it, right? You own physical gold in your own name, in secure private vaults outside the banking system with direct access for wealth preservation. Wealth preservation, right? And then you can own mining stocks for performance, right? Just look at some of the performance of some of these stocks, right? I mean, look, gold was up 65% last year. Silver was up, 165% last year, in that ballpark. So you're getting amazing performance anyway, just by owning the physical. But the leverage that I think that you can get from a number of these precious metals mining stocks is going to be absolutely tremendous. But there's a caveat. The caveat is that when you're buying a mining stock, of course, you're taking country risk, you're taking legal risk, you're taking jurisdiction risk, you're taking inflation risk, cost base, you're backing the management that they can allocate the capital effectively. You know, there are lots of other variables that you've got to bear in mind. So my advice on the mining stocks is, sure, have an allocation to the precious metals mining stocks as well. Absolutely, because I think they can go up 6 to 8-fold from here in certain circumstances. The cash generation of these companies is going to be absolutely tremendous. They're barely keeping up with the metals at the moment. But make sure you invest with a fund, with a diversified selection of companies, because I think, you know, picking an idiosyncratic, you know, one company, you just might pick the wrong one, right? You really got to be in the weeds with a number of these names, and that's why I would suggest, if you're going to buy precious metals mining shares, which, you know, I certainly think an allocation towards is very sensible, I would pick an expert to help you buy a diversified selection.
And although we likely have time for perhaps 1 or 2 more questions to come in, there was a question that came in. It's a good one. I think it's not perfectly aligned with our conversation and what Johnny's talking about relative to crypto, layer one, digital play, quote unquote, closeted ETF with bankers, Wall Street, and others suspect. I did a crypto-centric program who's also a believer in gold with JJ Sowers in December. Indirectly, we spoke about some of those things. I think that interview on that family office is still up. I will be doing more broadly on Bitcoin and crypto. There are plays in the world of, let's broadly go with crypto, that include physical gold as owned behind it. And again, why don't we save some of that part of the discussion for, as some of my guests will play out in the coming months. I am open to 1 or 2 other questions, but why don't we begin to take it to the home stretch? Johnny, I'd like for you to give a close, and I'd like for you to talk about, you're being too much of a gentleman. I think it's fair to discuss what Von Greyerz does is unique, location-wise, the setting, non-banking, and perhaps a way that families could understand that more and potentially reach out to you to learn more.
Yeah, look, thank you for the opportunity, and for anyone who's listened for the entirety of this discussion. And thanks for still being with us. Look, Von Greyerz is a Zurich-based wealth preservation firm specializing in helping high net worth individuals and family offices acquire physical gold and silver, physical precious metals, and storing those metals on their behalf in the world's most secure private vaults in Switzerland and in Singapore. For clients investing 500,000 Swiss francs to 5 million Swiss francs, that qualifies our clients to store their physical gold and physical silver in our vault in Zurich. And for clients investing 5 million and above, that qualifies them to store their physical gold only in our mountain vault, which is in the Swiss Alps, which is the world's largest and most secure private vault. It's a phenomenal facility. It's almost like a James Bond experience. It's got a private airstrip. It's got 9 security zones to get through to the King's Chamber, where the gold is stored. It's nuclear bomb-proof, gas attack-proof, earthquake-proof, and is absolutely phenomenal. So look, we are a one-trick pony, but it's a pretty cool trick. And we're a 100% family-owned business. The business was founded by Egon von Greyerz 25 years ago. He happens also to be my father-in-law, and he had a very successful career in business before investing the family's money in gold, using these principles that I discussed earlier, owning it physically in his own name. He started doing that for the family back in 2001, 2002 at $300 an ounce. And here we are today. We now have clients in over 90 countries around the world. And we're probably the biggest company in the world specializing in what we do. So anyway, you can get hold of us by looking at vongreyers.gold, or just email me directly, jh@vg.gold, and I'll happily send you any information about our services. The other thing I should say is that we have a lot of clients around the world who already have existing holdings of gold and silver, but they want to have it stored in our vaults in Switzerland. And so we are a one-stop shop for organizing all the logistics, all the transportation of clients' existing holdings of gold from a New York safe deposit box to a vault in New Zealand to our vaults in Switzerland. So we provide absolutely that service as well.
And by the way, some of you have noted the spelling of Von Greyerz, V-O-N, and then G-R-E-Y-E-R-Z, A-G, Switzerland again, Von Greyerz. Johnny, you're great. I am going to give a closing commentary, and I am going to briefly address a question or two that came in, and we might have a second of time for a quick question for Johnny as I'm doing my close. Someone does state, when does it make sense to own land? Now, that doesn't quite equate to our conversation today, but I can't resist giving it a minute. This is something I've done for my members more deeply, and I think it's a good question. Well, it depends. Where is the land? US, ex-US, where is it located? Again, supply and demand, proximity to resources, to cities, good or bad, to water. Is there potential for easements and tax advantages that could be structured in? I would listen to my ranch land discussion around the same time I did my discussion with Johnny the first time, late September, early October, should be up on that family office. That was also a very deep 2-hour discussion. So is it going to be used for farmland, for a secondary escape home, so to speak? What's the perspective for ranching, for self-preservation? Realize you can't take land with you. If the government wants it, they're effectively going to take it. That does not mean it's a bad thing. Broadly, I am a fan. In the US, I would look at certain states more than others. I'm going to keep that a little bit more for my members at the end of the day. But I do like the question. Some of you have stated, Angelo, are you willing? I've done it for my members, but not for the broader audience, to basically not a set topic, but basically take questions given my experiences from geopolitics, macroeconomics, investing within the confines of kind of the family office world. Sure, I'll probably do some of that. Others have noted, well, thank you. Usually it's questions about my forehead getting bigger, AKA my receding hairline. No, I'm okay. One of you said, Angelo, you kind of look great, but I think you're shaking a little bit. No, I don't have Parkinson's, but when I do a 2-hour interview, opening up a little bit, being very personal, I do have restless leg syndrome. So sometimes I do a little bit of that. I promise my health is good. I'm all good, but I am, I'm a rather energetic. And for me, I've had restless leg syndrome, my God, since I was probably in school, and teachers would slap my hand with a ruler. Johnny, they used to be allowed to do that back in the day in the 70s. Those days are long gone. I really enjoy this discussion. It really combines geopolitics, macroeconomics, and investing, and even indirectly AI. So like among my favorite subjects, Johnny is a great guest. Again, he will be a feature at my March 16th through 19th, really my marquee program focused on my members in Palm Beach. It's incredible. And my members can get a direct introduction from me to Johnny, not only at the event, obviously, but I've done that for others that just wanted a little bit more of a favorable intro. So really exciting for those of you live this Thursday in a couple of days at 4 p.m. Eastern. It'll be 2 hours in geopolitical issues, mainly with Jason Ma, his first return in about 18, 19 months, 3-hour interview the last time, some controversial things we discussed, and we'll see what direction it goes down on Thursday. I enjoy these discussions. I feel the family office world tends to be, at least those from my perspective, I think well-meaning, but a little boring and stodgy and vanilla, and don't touch upon issues that can be a little sensitive. Wait till you hear me and Jason Ma. And even David Lesparens from last week, and Philip Markovici, who was an incredible guest, a Cambridge background, and what he's doing there. That, we had some pretty major disagreement, but we agreed on some things as well. I'm not afraid to go down the road of Trump, the role of the global picture, socialism, the rise of that in the US, the impact on families of wealth, the California wealth tax, how I think that would spread. I said years ago, there was inevitably going to be a taxation of unrealized capital gains. I do think that is coming. And importantly, at least for my members, strategies to help address and deal with these. And some of them are deep and proprietary for my members. So I do recommend going to angelorobles.com, becoming a member, and getting access to an incredible network. I spoke to one of my newer members of early last year, who actually did meet Johnny at the last event where Johnny spoke in March in beautiful Palm Beach. And he's a big investor in food and beverage, and noted to me that, Angelo, just that one event, I didn't really have time for others. And I don't even read too much of your handbooks. That really hurt my feelings a little bit. I'm known for some of my content, good or bad, that's proprietary for my members. At that one program, he met 3 to 4 incredible relationships. I believe one co-investment that they're doing in food and beverage. And he's very, very successful, has his own mini family office that he runs as well. The people that you meet, forget about me and even the thought leaders, it's the fellow peers and connectivity in a private, beautiful setting. In that example, over 4 days, that makes it special this March. If you're in Miami, as I noted, Monday the 26th, I'll be at the Ritz-Carlton speaking and leading a family office day on uncorrelated alts. I hope I could see some of you there. And again, I think there's a value in joining and being a part of my community, my private intelligence and strategy community, and going to angelorobles.com and learn more. Yes, some of the commentary, Angelo, you're too long-winded. Your closes are long. I promised I would shorten them, and I'm not living up to that in this one. So you're not incorrect. So my bad, but sometimes it's a little hard for a tiger to change its stripes. And Johnny, there might be one mini final question for you, and it might be a little off topic on a commodity. Palladium and platinum talks a little bit about South Africa, some of the nuances, and maybe, again, it's a little bit out of the bailiwick, but do you have an opinion on that precious metal and commodity?
Yeah, we're bullish on them. We get asked that a lot. We were able to buy platinum on behalf of clients, but the only thing I would say is, again, it's a very, very illiquid market. It's more illiquid than silver, and silver is becoming more illiquid. So the answer to the question is yes, we're bullish on both platinum and palladium, but just be mindful of the liquidity in those versus silver and gold.
Understood. Johnny, I appreciate your time. We're almost up to 2 hours. We each have, it's late in the evening where you are, relatively late in the evening where you are. So I want to let you go. I look forward to seeing you in a couple of months in Palm Beach. It's always a pleasure when that occurs. Thank you for all your time today, audience. Greatly appreciated. Hope you're enjoying some of the content. Lots of things to come this week. Next week, I'll be traveling. Maybe I'll do some things live from Miami with some of the other guests that will be there over those 3 to 4 days that I'll be there. We'll see. But when I come back first week in February, I have some incredible guests on. So it's all going to be great. I thank you all for your time. And again, Johnny, thank you so much for your time today. See you in 2 months.
Thanks so much for having me, Angelo. Much appreciated. See you soon.
Pleasure.
Bye-bye.
Thank you.
Bye.
Bye.